that's why we would prefer Mastercard. So the similarities would be their role in the infrastructure. So at the end of the day, they are both providing that same service of passing the payments over those rails. The main difference, as we see it, is in their sort of their exposure to the different types of swipes, if you will. So then it becomes about where can you make those little marginal gains, what portfolios can you start winning, and what other services can you add that is outside the core payments infrastructure before another competitor does. It absolutely could, in the sense that if that new conglomerate decides that they are going to participate in a race to the bottom, it could be a disruptor, absolutely. So in advertising, for example, retail media is absolutely blowing up. But the whole point is retail, right? So that means that the payment players are getting involved in that too. So who is able to buy up the little add-ons? It's going to be the company that has seen this newest wave of growth and has not yet reached a size where they're tipping off regulator.
Welcome to Global Money Talk. I'm Dan Ha. Today, I'm joined by Shelby McFadden of Motley Fool Asset Management. She'll be talking to us about Mastercard. Shelby, welcome.
Thanks for having me.
Okay, so Mastercard. How long have you followed it, and what got you interested in the first place?
Yeah, so I've been following Mastercard, I guess we're in 2025, almost 4 years now.
Okay.
So I did inherit the coverage when I took my role at Motley Fool Asset Management, but it's been something I've been grateful to continue to cover because it's a great bellwether for just consumer movement.
Okay.
Similar to how we're all going to be looking to see what the banks are doing this week, having a look at the global payment networks also gives us an idea of how individuals are spending. It helped to get an idea of economic recovery immediately following the COVID pandemic, especially when it came to like cross-border. And then it also gives us an idea into the sort of fraud protection markets and different trends there. So it's really useful in my coverage, I find.
Okay. So tell us a bit about the history of the company. Obviously, Mastercard, Visa, history pretty well documented, but I think for the benefit of our viewers, if you could touch on the history and also focus on the sort of the more defining moments for the company in its evolution and how it got to be the duopoly that it is today with Visa.
Yeah, absolutely. So Mastercard, as you mentioned, is Visa's peer in a global payment network. So we like to describe that as they're an arbiter of the rails. So all the different ways that we conduct payments, they're part of that infrastructure. And so one of the really big first parts of their history is getting more people onto the debit interchange. So getting away from cash. Now in 2025, we're pretty much at the end of that sort of cash conversion. But first, just getting everyone onto plastic. And then one of the next big things after we had the restrictions on debit fees was credit. So going ahead and making that an even bigger part of their operating model and being able to take advantage of the different sort of regulations and regulatory environment when it comes to credit there. And that's also where they compete a bit, sometimes better with Visa, especially when we're looking at the US where they've got less debit exposure, more credit exposure compared to Visa. And then I think the sort of third stage for Mastercard is where we are now, which is where they're getting a lot of their growth from what they call their value-added services and solutions. And so that's where we start getting into security, fraud detail, all things like that, as well as different things that are linking consumption data that can be used for different growing segments like retail media, things like that. So all the different types of services that can be provided, not just over the rails that we're used to, but also different things like buy now, pay later, which use a debit rail, but it's a newer service. And then also looking into how they can increase their services with open banking, how they can find ways to make ACH something that actually can be a bit more profitable, while also getting merchants to want to continue to use the debit rail. So that's how I would kind of break up the history into threes there. Okay.
I do want to come back to the value-added services, but can you just kind of compare and contrast Mastercard with Visa? Tell us the differences, the similarities.
So the similarities would be their role in the infrastructure. So at the end of the day, they are both providing that same service of passing the payments over those rails. The main difference, as we see it, is in their sort of their exposure to the different types of swipes, if you will. So Visa having a lot more US debit, which when we were going into this time thinking, how is the US consumer doing? Are they going to slow down? We much preferred Mastercard because they had a bit more European debit, but more US credit. And so being able to have a really more robust consumer when you think of credit, because if that's what everyone is switching over to when their savings are drawn down and they're not as liquid, that was a position that we kind of preferred. But when we really look at it in terms of what are the competitive advantages in terms of their operating model, that's where it gets a little bit hairier. So for us, the decision is really about what type of exposure do we want, and knowing that the profit margins right now are going to be in credit rather than debit. That's why we would prefer Mastercard. But when we look at Visa, also knowing that they do have very solid partnerships. It is a company we've looked at in the past. We've gone kind of back and forth. But in the environment we've been in right now, wanting to make a choice, not wanting to sort of overload that exposure, we've chosen Mastercard for really the reason of just having that preferred credit exposure.
You said that, you mentioned that competitive advantage discussion of that could get a bit hairy. What do you mean by that? Why is that? Meaning
that oftentimes when we're looking at this situation where it's kind of a duopoly, you could say it's an oligopoly if you want to throw in American Express, having credit in there. They have this ceiling where they can't make any particular acquisitions that let them get too big, because then the Justice Department's getting involved. But they're also not going to race each other to the bottom in such a way that they're going to allow competitors in. So then it becomes about where can you make those little marginal gains? What portfolios can you start winning, and what other services can you add that is outside the core payments infrastructure before another competitor does? And so that's where you start sort of going bit by bit. Instead of taking 2 steps at once, it's putting 2 feet on 1 step. But then figuring out who can get there first. So we sort of view the competitive advantages not necessarily in the operations, but in where they've chosen to operate and exactly in which verticals, which is much harder to sort of pull yourself out of. Visa has done some footwork to change their allocations geographically, as has Mastercard, but that takes a while. And you don't want to necessarily just pull up any one of your portfolios when you are depending on that income.
Got it. Why is credit more profitable than debit?
It has to do with the regulations on interchange fees. Okay. So we are starting to see a little bit of push now for a bit more regulation in credit. In debit, those are capped. And one of the reasons is it's going to generate competition because now Visa and Mastercard cannot just have this monopoly or duopoly rather on interchange completely. It allows smaller players to get involved, and it also makes it more appealing for merchants to accept those cards. And if the interchange fees are not so high, consumers are more likely to patronize an establishment because they can use their cards and not have to use cash. So it was something that lawmakers at the time felt would be better for competition and also for consumption. Credit card doesn't face the same limits. And so while they are not gouging people because, just because there's no policy, you do get a little bit more off of every credit card swipe at that point. And so that has been more favorable, with also the increase in Gen Z and millennial consumers choosing credit cards almost as like coupon clipping. What is this card going to do for me? Well, this is the card I have for travel because I always fly Delta or I always fly United. But this is the card that I use when we're going out to eat. And this is the one for groceries. You could have 3 different issuers there. That is going to be more lucrative for every one household versus you usually have got one debit card. And increasingly, people have a debit card that they don't use.
Right.
They essentially just use the debit account for paying off their credit balances. So unless there's going to be more regulation, and unless that successfully goes through, then credit would continue to be more lucrative than debit.
Got it. Visa and Mastercard also have different geographic exposures or geographic mix.
Yes.
How does that factor into the profitability of those companies?
What it'll do is it makes us look at how their greatest exposure is faring in the macro sense. So with Visa, at the time when U.S. consumers, we weren't really sure how it was going to go, there was a concern of they have a lot of debit exposure. How is this going to suit us if consumers have less and less cash? But then Mastercard didn't get away scot-free. They have more European debit exposure than U.S. And when Europe was recovering a bit slower than the U.S., that was a difficulty for them. Their cross-border spend in and out of Europe was something that slowed them down quite a bit. And so you're really having to deal with the sort of ebbs and flows of which geography is excelling compared to the other. And so it's not something that's always going to continue forever, right? It's something we watch out for, something we're very aware of, knowing that there could come a time where maybe U.S. debit snaps and comes back around. When we just looked at the Capital One and Discover merger, realizing the power to potentially make debit more exciting, it's a possibility, right? We now have these two institutions coming together that have the know-how with credit card rewards, but also have the setup for debit, a bank. There's a real opportunity there. Who knows how successful it's going to be? Debit rewards in the past haven't always succeeded, but there's a chance there. So it really just comes down to where we are in the global economic cycle that can really determine which one of those you might want more exposure to. And then, of course, if you're kind of just looking to have the overall exposure, you could just kind of, go with a 50-50 or a 60-40 in the two.
When an issuing bank chooses between Visa and Mastercard, what is that decision-making process like? Like, what are they evaluating? What gets them to choose one over the other?
It's really going to come down to acceptance. And at this point, acceptance between the two is pretty much parity.
Right.
And so in effort to not completely race each other to the bottom, that's where those value-added services come in. So what else can I do for you, right? What can I do that is not going to cost me tremendous amounts of money to keep your business to the point where I am undercutting myself, but also is going to convince you to stay here for a few more years. So when we think about some of the major store card partnerships, sometimes they don't re-win the bid. Sometimes when it comes back up after 7, 12, 15 years, maybe they don't get it. So they have to, continue to hold on to those, but also knowing that their income stream is that way, where it's like, okay, we've secured this partnership and we know that it runs until this period. They continue to secure those long-term deals. So it really does come down to what additional can you do for me? And is there a major difference in acceptance between you and Visa? So within the US, it would be probably, if we're talking about comparing the two, it can be a little bit more sticky because it's pretty much parity. But if you're going international, depending where, which continent, which sort of sub-region you're looking at, then it could be, okay, Visa or Mastercard has a more established position here versus there, so maybe it's really not even competitive at that point. And it also just comes down to where the operators want to risk doing business. Where do they want to be a part of growing something versus assessing it as too great a risk to even, put any capital down?
Can you elaborate on that?
Sure.
Yeah.
So when we look at, let's say, Latin America, and then also comparing the Chinese market and Far East markets, those have been, they're not always equally successful for any two players that make an attempt. And one of the reasons is because in that region, a lot of the governments have already figured out how to do more effective and more cost-effective person-to-person payments, right? Okay. And that is something that also just makes doing business easier, right? When we think about, let's say, going to the farmer's market, it was probably, in the last decade that you could start tapping your card on a little square or things like that. It used to be all cash. But there were countries that were ahead of us, already making payments with their phones. And it's harder then for a payment rail company to break into a space where they have already figured out how to transfer payments really easily. And so it has to be the first to get there to decide, we're going to try and make this investment, but there also has to be something to break into. So if there's already a pretty solid infrastructure, you're then going to have to try and find a way to add value. And that oftentimes will be, okay, how can we connect you with the rest of the world? What other cards can we offer with a multinational business that can be used in this country and in the United States? So it's a little bit more of a one who's been there already in terms of like who's going to plant their foot down. There is a little bit of a first mover's advantage. And then tapping into markets that are early in their cash to non-cash conversion, it is then about who's going to get there first. And then those decisions are where we have to trust those operators to make the right ones, honestly. And that's something that we're then reviewing in terms of their return on invested capital. And then just really looking out to say, okay, how are these ventures all going? Because when these companies get to be this big, it's very easy to just assume that they're allocating capital properly. Yeah. But sometimes they start just sending money back to us. And we think, okay, are you out of opportunities? Are you out of ideas? Has someone else beat you to this specific market? So on and so forth.
I mean, at this point, though, are there even any sizable markets left where Visa and MasterCard have to make that conscious decision of, are we going to invest in this market or not?
And that's a great point. And at this juncture, I would say not really. In terms of how they're going to plant a flag for payments infrastructure, where they're going to really be an intense part of it, not really. It's all going to be how can we add to this? Or what can we do to make retail more exciting? Or what can we do to serve consumers that have not yet experienced credit card rewards and things like that? Because that is something that is still growing. So the overall infrastructure, the introduction of like the foundation of it, I do think that we're kind of past that point.
Okay.
But continuing to spread the concept of having a card that works for you, getting something for your payments, that is, I think there are still places where you can make that market, and they're trying to do that, but having to do it responsibly and thoughtfully.
Got it. Let's talk about competitive landscape a little bit more. In the U.S., it's pretty clear, but I still want to talk about it. But before we do that, in ex-U.S. international markets, what does the competitive landscape look like? Perhaps by region. There are some homegrown players in certain markets. So how dominant is Mastercard in those markets?
I want to say that Mastercard's most dominant presence is really Europe. They had for a long time, they had the Maestro cards for debit. That's something they started to phase down. In terms of international, that's where that's a really large presence for them. I also want to say that they were pretty competitive with Visa in terms of LATAM. China has been difficult for everyone. That is just a challenge.
Right.
But it's also because, again, they already had a very strong payments infrastructure, and things are regulated differently there, so it's not as simple to walk in with a value proposition. So I think that Europe tends to be a very competitive space because you're also looking at, yes, there's a shared market, but there are also different smaller markets. And yes, there are shared regulations, but at the same time, that can make things very sticky, and it can make them question things over and over again. Things can get refreshed. So there is a bit more opportunity there. I think off the top of my head, I don't recall who has the greater share of Canada. But in most of the calls at this point, the strategy is focused on LATAM and Europe, because that is where the cash conversion is pretty much done. And so it's about getting those marginal gains on value add. But it's also where you're not looking necessarily at, not emerging, but markets that are just the focus markets that still have a lot more growth compared to mature North American and Western European markets. So a little bit in North Africa, there's some interest there. But the thing is, they also need to know that they can have these agreements. They're not just making a now sale. It's not a one-time sale. It's what is the go forward basis for this company that we're going to work with, so that we actually have a relationship with one another. So I think the international opportunities, again, are predominantly Latin America and Western Europe. Okay.
What about the competitive landscape here? We touched on it briefly, but American Express obviously is more of a premium player, so it's unlikely that they take significant share away from Mastercard, Visa. But with Capital One and Discover tie-up, could that potentially disrupt the landscape?
Yeah, it absolutely could, in the sense that if that new conglomerate decides that they are going to participate in a race to the bottom, it could be a disruptor, absolutely.
Yeah.
When we look at the standard customer for Discover and Capital One, put them together, it's a similar demographic.
Right.
We do know that Discover and was a little bit more students and entry cards, things like that, with Capital One having a bigger book in personal loans. But you put those things together, you get generally the same demographic. If they are able to partner with brands that their demographic frequents, and they're able to come in at lower rates for that particular card, or they're able to offer something more unique on that card because now they have an issuer, and they have the bank, and they have the rails from Discover, then you have a different story. And so in the past, they've had to kind of do those two things separately. If now they can come together in this institution that is similar to what American Express can do, but they have debit and credit, now it gets interesting. But at the same time, we want that. We want more competition, right? So this would actually be a great time to be looking at Mastercard and Visa's management and saying, what are you guys going to do now, right?
Well, consumers want more competition, but Visa and Mastercard don't.
Of course they don't, right? But as capitalists, we kind of do. We want to see what they're going to do with the money we've given them. Are you going to sit on your hands and send it back to us? Or show us what you can do? What is it that the salaries listed in the proxy have been paying for? Show us the competitive advantage. What can you do beyond scale? And so, of course, yes, it's something we're looking out at, but also knowing that a race to the bottom is a choice.
Yeah.
And so it is a risk that Capital One Discover would have to be willing to take, and it is a big risk, especially in this environment.
Does the Capital One Discover tie-up actually reduce potential regulatory risk for Visa and MasterCard? That it's harder to argue
that they have too much share?
Yeah.
I think it could, yes, because if you now have another debit credit conglomerate instead of just having the two and then everyone else being fractured, yes. The other side of that argument that I've also heard is, great, we have another conglomerate now. So now the three of them can partner up together. So it's a little bit of which one is going to happen. My personal belief is that I think we'll be more likely to see Capital One and Discover go a bit more of their own way, because I don't expect them to have this massive character change in how they do business. Discover is known to have the next best customer service after American Express. So we know that is a huge addition to Capital One, which is known to not have the best customer service, just objective. And if they keep that, that's great. But if they also keep other things about Capital One that haven't changed, then that doesn't really, it won't determine how much more competitive or not they would be with Mastercard and Visa. But if they really are able to tap into some of those synergies and bring themselves forward and get competitive in some of these branded partnerships and retail partnerships, then yes, that makes life difficult. But I do also think that Mastercard has gotten ahead of, not that they could predict the future, but starting to lean on the growth from value-added services was a key decision by management. Getting ahead of that early, starting to pile up those high teens and low 20s growth in that segment was massive for them. It's allowed them to potentially absorb a hit. And again, it's still really early days. We have to see if these synergies play out, or if they end up kind of just acquiring this asset and using what's good, but not, multiplying on anything.
Got it. Let's talk about the value-added services business. When did they start it? How have they developed it? And what are some of the more exciting offerings from the value-added services business? Yeah,
so I want to say it's definitely been around since my time covering the stock. So it's probably, I don't know, in between 5 to 8 years old, if I had to say off the top of my head. And I would say the business was growing at its peak probably between 2021 and 2023, a little bit into 2024, and they had a teensy bit of a slowdown. The main selling points for that are cybersecurity, fraud protection, because now that payments are going across so many different rails, there's so many different methods. We were just having a discussion that now with buy now, pay later, one transaction is 4. Right? Anywhere from 2 to 4. So it's just crossing the rails over and over and over again. The amount of consumer data that's just floating around. When you introduce retail media into that, you introduce things like Shopify, where you're just you're paying with a passcode. You log in and everything is just sitting there. They are not just working with issuers and with merchants, but with anyone who is dealing with transaction data and being able to offer them some of those services. So yes, they're able to cross-sell, but they're also able to sort of add them in with people who have acceptance from all of the different payment networks, but are wanting to use this particular service. So it's probably been growing. I think there were a couple of quarters last year where it was more like mid-teens. They had a little bit of a slowdown. But yes, mostly cybersecurity and fraud, which we have seen, I think, largely in the tech space in general, but especially in payments. And given that there is still such a reliance on debit, it's just required that you need that more and more often.
When you say cybersecurity and fraud, what are they actually doing?
So, I'm sorry, go ahead.
For the customer, what are they actually doing?
The way they kind of describe it is a protection of the rails, is what they say. So essentially making it so that the data that is running through about customers and also about these businesses in and of themselves is secure whenever these payments are processing. So all of the information that has to sort of go into the ether of the payments infrastructure system, I mean, I don't know if it's happened to you, but I've certainly woken up in the middle of the night and been told, your card's been compromised, there's a new one on its way to you, we canceled it. Mm-hmm. So what they're doing is trying to stop that from happening, specifically in the payments infrastructure. So it's not something they go into too much detail on the calls, and I think part of that is just they're trying to protect their competitive offering. But instead of it being reactive, it's what can we do to secure those rails for customers before something happens.
Got it. B2B payments is also something that the company talks a lot about as a potential opportunity. What is that opportunity?
So the opportunity in B2B payments is an interesting one, and it's something that we have seen, you're right, with Mastercard, Visa, American Express, and it is really the concept of businesses need their supplies and they have to pay their suppliers. And oftentimes, supply chain financing might look like just agreed upon terms and you write a check, right? Or maybe it's ACH, or depending on the size of the business, it could be cash, right? As long as you are keeping track of all of your cash payments and things in a ledger, you are clear with the IRS. So there has been a really big push to make it more attractive, especially for small and medium-sized businesses where a lot of these companies are focusing on, to have some sort of card or revolver and make it accessible to them when they're making, let's say, $15 million a year. You're a little bit smaller, you don't want too many cards running around, you can't have too high of rates, but if there's some sort of reward that you could be getting, if you could be enticed to use this product, then it can be a win-win for both, where you don't have this outrageous fee, it's manageable for you, the rates are manageable, the terms are manageable, but you're also able to get something for your business or for yourself, whatever it is, via rewards. That's a market they want to tap into. How can we get them off of writing checks? How can we get them off of ACH? We can do that by attracting them with rewards or better revolver terms. So that has been a key market, I think, across a lot of companies, frankly. I mean, even when we look at something completely in left field, like UPS, they have been after small and medium-sized businesses for ages. The B2B market in general has been not ignored, but I think underpenetrated. And a lot of companies are realizing that, hey, there's this whole other section of transactions that why should we not be a part of that? And why should we not offer rewards? Because at the end of the day, they are still people that are transacting. They're just, they're people who are running a business. So why not be a part of that?
Got it. Because the core payment processing business is so profitable, the value-added services business relative to that is actually less profitable and margin dilutive to Mastercard. As an investor, how do you feel about that? How do you assess that?
It's something that it's part of what we call our say and do ratio. So if management is letting us know that it's supposed to be growing in the low 20s and that they're continuing to leverage the costs that it takes for that business, then we're watching out for it. When they're letting us know that, okay, right now the environment that we're in is that people are scaling back, the corporate budgets are small, this is not something that's going to be particularly additive right now, then we're prepared for that. And then we kind of look and see, okay, at what point are we going to divest from that business, or is this going to be part of the macroeconomic cycle? So yes, the core business in and of itself is going to really drive their performance because it's also just the sheer scale of it all. The past year or so, value-added services has not been at its, like the trailing 12, has not been at its strongest. I think they were performing a bit better 21-22. And they have warned about that, saying that, it's been a little bit slower with corporate divestment. So it's something that we do have to watch out for. But because we also know that we want them to be somewhat diversified and not completely dependent on the payment infrastructure, it's a risk that we're happy to accept at a certain extent because it gives some diversification to the company.
Okay. Mastercard's profitability is less than that of Visa's. Do you ever see that gap closing?
I'm not sure how much it can narrow completely. But one of the reasons we do still prefer Mastercard is, again, those types of exposures. So the other thing is that Visa, in times of difficult economic results that we've gotten out, they have tended to be a bit more volatile. We don't choose our companies just off of how we think share price is going to do arbitrarily in the market. But the investor has shown to be a little bit more sensitive around Visa. They tend to absorb a lot more of the shock, especially when the U.S. is looking a little bit murky in terms of outlook for consumer. So Mastercard is, scale-wise, of course, a bit smaller. But we don't see them losing share to the next below them unless there is just absolutely something just meteoric that Capital One Discover is able to come up with. But I wouldn't expect them to be able to completely catch up to Visa, because you get to a certain point where once they've sort of established that top line scale, it's sticky. And what is it going to take for Visa to lose an entire large bank system where they are currently issuing all of their cards? That takes a lot. Because it's a tremendous undertaking to replace everyone's card. So you get to a point where you need to, you land, you expand as much as you can, but it's more expanding laterally instead of necessarily trying to eat up share from the next above you.
Got it. So profitability-wise, Visa, it's your view that Visa will continue to be more profitable, and Visa will continue to be meaningfully larger in size than Mastercard.
I think Visa will continue to be meaningfully larger in size. I do think that there could be competition for who's going to be more profitable. As we kind of discussed earlier, the payments infrastructure in and of itself is kind of set. But I do think that Mastercard has been a little bit more dynamic in some of their decisions. They've been a little bit quicker moving. And again, being a little bit less US focused, realizing that we are not the only market where things are dynamic and they're changing, and where there are growth opportunities. And also, candidly, the US consumer has been a little bit slower to accept different methods of payment and to try different rails. It took a pretty long time for us to get all on debit, and lots of other countries had just skipped that entirely. So with MasterCard having a little bit more international focus, that gives them an opportunity, I think, to try and be a little bit more be a little bit more creative with how they're expanding their profit margin. So yeah, that's kind of where we sit on the two of them. But we do have write-ups on Visa, and we kind of check on it from time to time and see where it might ever fit in adding it to maybe another portfolio.
You said Mastercard's been more sort of dynamic and sort of quicker. Why is that? Is that management, culture? Like what's made Mastercard more dynamic than Visa?
I think part of it is the very landscape that they exist in, where when you are number two and you need to solidify your position and try and pick up any extra ounce that you can, you are forced to. So when you are not the primary debit issuer in the United States, and you are now up against two other credit card issuers in the United States, you need to be dynamic. And if you want to maintain and potentially grow those positions, especially credit here and then debit elsewhere, you have to be moving. Especially looking at this environment where we had a lot of private equity money get pumped into fintech, that has been a thorn in everyone's side, because the regulations are completely different. The way that they build their loan books is just completely different. The way that they see the world and the capital that they have is not really comparable to the sort of legacy way that things have been done. And so I think that's what forces them to be a little bit more scrappy and to re-examine their propositions. I have seen in my time covering the stock, can't name off the top of my head, but they have offloaded things. They have sometimes had assets that's like, this is not performing. But then they've also continued to buy different things and go into different partnerships. So they are being, I think they're able to be a little bit more nimble. Yes, they're large, but being, a couple steps smaller than Visa can sometimes work to their advantage.
Got it. You mentioned fintech, emerging competition for Visa, MasterCard. It's been around for a long time. Never really rose to be a meaningful threat to their business. Will that continue, or do you see that potentially changing in the future?
Meaning, like, will they kind of continue to be more of just like an ankle biting kind of situation? Right.
Visa, MasterCard have successfully have fought these emerging competition. And none of them really, PayPal, Venmo, sizable businesses, but not really a meaningful threat to Visa, MasterCard. I think people could, I think we could agree on that. Will that continue, or do you see sort of change on the horizon from emerging competition?
I think that the competition will not necessarily be nullified. but I don't expect it to be any more cumbersome than it is right now. So they're constantly aware of it, and a lot of times they're looking out for these little things to pick up in those little add-on acquisitions and just say, you know what, we're not going to build that ourselves, so we'll just go ahead and add this on. We'll take those capabilities. I think that you will probably see, or there's potential to see, I should say, coming out of the Capital One Discover merger, a renewed appetite for maybe picking up fintechs or partnering with them a little bit more. So you might start to see that if it gets to be part of the competitive landscape, like, hey, we need to work a little bit more with these guys, then that's something you could see. But I don't necessarily see it having a big sway on their profitability. But it'll be something they need to be aware of, because it also just changes the landscape, and no one can fall asleep at the wheel. Not Visa, not Mastercard, not American Express. Everyone needs to be alert about what the preferences are in how they pay and how people pay and what they want in return for processing payments over that system.
Got it. We briefly touched on regulatory risk earlier. How do you see that evolving? Obviously, the new administration is supposed to be more sort of friendlier to larger companies, but how do you see that evolving, the regulatory landscape?
You know, we've been keeping an eye on the proposals for credit for a while now. I mean, I think it was one of the first stories that came up in my early days of covering, and it hasn't progressed very far. And that's not to say that it won't, but it just goes to show how long it takes. And so with the new administration coming, things could be different. They could move quickly. So maybe they make a decision in one way or another, and it's quite fast. The difficult news of more regulation or cap on credit is it hurts profitability. The good news is that everyone has to deal with it. And so if we look at the fact that, okay, Mastercard and Visa are not banks, okay, so they're not the ones who are necessarily having to they don't have to pay the full share of all the rewards, right? They pay part of the share for different rewards programs. So everyone's going to get hit a little bit. But they also are making these transactions happen. So they have a little bit more leverage in terms of, like, here's what we're going to accept and here's what we're going to give in return, because at the end of the day, you need to cross the rails. So I would expect it to be something that could cause a step change for the entire environment, but not necessarily would make Mastercard a less viable business. Now, in terms of the debit versus credit exposure, yes, you would then have to look at the fact that it's like, okay, how much US do they have? How much US credit versus Visa's US credit, and say, okay, this is where we might need to adjust our valuation. Now I need to kind of look at what my expectations are for revenue, but I wouldn't expect it to be something that says, okay, well, now my fair value estimate is 20% off. That's not something that I would be expecting to come out of that sort of regulation. But that's a really long-winded way of saying it's hard to know which way this is going to swing. Because yes, pro-corporation, as I think is the conclusion for the new administration, but also pro-consumer in many ways. There's very much an appeal to what the average American is going through.
Right. And
the average American is oftentimes upset with a lot of these extra fees and how much more it might cost to get something with a card versus cash, especially small business owners.
Right.
And so if we are to be a country that is encouraging the growth of small business, then that's going to be directly in conflict with allowing credit interchange rates to stay exactly where they are. So it's a really long-winded way of saying we're going to find out. Yeah.
What about litigation risk? How do you deal with that as an investor? Obviously, you know, a company that size faces a lot of potential litigation risk.
It is unfortunately something where we have to take management's word and follow up when we're not comfortable. So regularly reading the filings, seeing what's new. When there are things that are ongoing, the market tends to know about it. So if the European Union is going to launch a really large investigation, or they have a really big case, things like that, that's something that they're not able to hide in the filings. We're all going to know about it. And they're usually, after a few months, they're able to kind of give an estimate about, like, this is how much we think this is going to cost, so on and so forth. So it is something we have to just accept with companies of this size. Now, if there was a pattern where a certain set of operators are constantly finding themselves in trouble, which I have seen in certain other companies that we have disposed of in the portfolio, then that's a different situation. But if it is part of the risk of doing business and how the payment networks do business globally, and it's a habit of all of the networks, then it's something where we have to kind of just accept it and then hold operators accountable where we can. But it is unfortunately kind of like in the 10K sort of risk where it's, you're going to have to deal with how various global governments feel about how they're operating in the country. And if they have done something wrong, then we want to hold those operators accountable.
Got it. As you follow the stock, what's been the most convincing bearish argument on Mastercard?
Bearish argument on Mastercard. I would say it's mostly just been on the valuation.
Okay.
And ourselves, we have often asked, how is it here? Again, we love the company, but I've even myself said I'm not getting there. I'm not getting where the market is getting. I think the bearish argument is in twofold. One is that the value-added services can only grow so fast for so long. And two, what will they do if they cannot get bigger? What will they do if they kind of just become just a simple kind of core play and the market gets tired of rewarding what is essentially, in some cases, I shouldn't say essentially, but what is in some cases growth because of inflation? That is probably the bear market, or the bear argument, and that is one of the reasons why we are not as bullish on the valuation, is because when you look at what's driving the top line, so gross dollar volume, but then also switch transactions, the gross dollar volume is, yes, constant currency, but it's not adjusted for inflation. So it is still nominal. It's just, FX constant. So it's a situation where in the US, you've had this pretty significant inflation, and that is going to continue to drive the top line. And you have to be able to parse out what is it that they're adding. So we feel confident about their ability to hold their share and to occasionally do some things that surprise the market and delight the market. But I think the bear argument would be, what else is so special beyond this being a core play? And for us, it's core. But the valuation has it as growth. Yeah. And so I think that would be the bear argument is, I don't know that this is a growth company.
So just to be clear, you don't like the valuation, but you do like the stock.
Yes, we do like the company. Yeah. Absolutely. And we're happy to hold it. We hold it in many places in our portfolio. And when we are going through, like when I'm doing my quarterly attestations and things like that, I'm usually marked as a hold, or let's trim it if we need cash. Never a vapid sell because it's too much, because we do really like the position. And so we are aware of the risk that we take, but also knowing that it has continued to deliver. So you have to kind of walk that line of knowing, hey, the market as a whole, sometimes they're going to know more than us. An aggregate of people having this idea and agreeing on this price, we have to kind of balance what all of the other sell side as well has come together and figured out with what we believe. And we do that via allocation.
And just comparing it to Visa, Mastercard trades at a premium to Visa on a PE basis. So doesn't that make Visa potentially more attractive?
If you're going purely just off of price, then yes. And that would make it more attractive if we said, okay, what do we want to add to the portfolio? So if we basically said we want more payments in total, then maybe we would say, okay, let's go ahead and essentially we can find a hedge between the two, right? We can find a way to have exposure to both in the portfolio in a way that suits us for what we think they both excel at. And we have looked at that in the past. We have Visa in our universe for us to sort of dip into from time to time. And looking at these multiples, it is, when I think about where the average company is trading these days, to see a 2 in front of anything, is you say, okay, wow, core company trading at, what is this, 27 times forward price to earnings? Okay, that's actually somewhat reasonable in this market. So from a pure valuation perspective, yes. When we think of our long-term vision, I think we still prefer to just, if we had to just say valuation agnostic, what do we want to hold? We're choosing Mastercard. But if we're saying we want more payments infrastructure, we want more diversity in our payments infrastructure, then we could say, okay, we can use some of our some of our proceeds from trimming Mastercard that we believe to be a bit rich, and go ahead and choose some Visa. But I think I guess to point out why we believe that, we have these 4 pillars of quality at Motley Fool Asset Management, and the first is management culture and incentives. Second is economics. The third is their competitive advantage, and the fourth is their trajectory. And so when we look at all of those things, for us, it's Mastercard that's coming out. And so that is why we're going to continue to hold it, as opposed to sort of running Mastercard has run through its valuation runway, let's switch out our exposure and get Visa. We tend not to think of things that way.
Got it. And just to finish on that, in order to justify Mastercard's premium valuation over Visa, one must, I would imagine, have to assume that Mastercard is going to grow faster than Visa, just given that the quality difference between the two companies isn't that dramatic.
And, I'm sorry, go ahead.
No.
Yes, and that's exactly right. So when you look at a company that is going to be smaller in size, it's the same reason that a lot of times investing in small caps can be painful sometimes in this most recent market, but exciting, because the whole point is to watch them grow and figure out what that sort of right size is for them to be a long-term profitable business. So when we look at the fact that, yes, Visa has amassed themselves to a certain size, and Mastercard might still have some room to run. And so that is the sort of opportunity that I think the market is pricing a little bit more, and realizing that Mastercard is not asleep at the wheel in the United States. Maybe they don't see it as much, but knowing that they have they do have some presence in the U.S., and then knowing that they are trying to be more dynamic internationally, it all comes back to the same shareholders. So I think that the market is catching up with that and realizing that there is something fundamentally to gain by choosing Mastercard.
Got it. And to believe in that, you do have to believe that Mastercard is going to win share away from Visa.
Either from Visa in payment infrastructure, or finding new ways to add value for their payment clients. So at that point, and it is possible, right? If you are of a size that is just small enough that you can continue to add capabilities without facing regulatory difficulty, then that's a win. And Visa is at a size where things can get a little bit more challenging for them, whereas Mastercard is able to sort of tack things on and add on capabilities, especially where new markets are being made. So in advertising, for example, retail media is absolutely blowing up. But the whole point is retail, right? So that means that the payment players are getting involved in that too. So who is able to buy up the little add-ons? It's going to be the company that has seen this newest wave of growth and has not yet reached a size where they're tipping off regulators. They don't have forever to go, but they have a little bit more runway.
Got it. Well, that's all the time we have. Thank you very much again.
Of course. Thank you for having me.
That's it for Global Money Talk today. Thank you for watching. We'll see you next time.